In recent years, skyrocketing inflation has severely strained Americans' budgets, making it harder to cover living expenses and save for emergencies. A staggering 36% of adults now have more credit card debt than emergency savings, marking the highest level since Bankrate began tracking these figures in 2011. This financial crunch underscores a growing vulnerability among households nationwide. What does this mean for your financial future? Let's explore the statistics. 1. 56% of Americans need help to afford a $1,000 emergency expense from their savings account. A recent Bankrate survey found that only 44% of Americans can handle such a financial shock. While this is a slight improvement from the previous pandemic years, it still means 56% of people would need to find other ways to manage an unexpected expense. Most would resort to credit cards, borrowing from friends or family, or even taking a personal loan. A small percentage could cut back on spending to make ends meet. Mark Hamrick, a senior economic analyst at Bankrate, highlighted that many Americans are financially vulnerable. The ever-increasing wealth gap and inflation have exacerbated this situation. Inflation, in particular, has made saving for emergencies more challenging. Nearly two-thirds of Americans reported that rising prices have forced them to save less. However, 19% of respondents said higher interest rates have encouraged them to save more. Another stress factor is job security. If they lost their jobs, two-thirds of Americans surveyed say they would struggle to cover their living expenses even for a month, with 42% being very worried about this scenario. Despite these challenges, Hamrick believes there is still hope. The feared recession didn't occur, and the strong job market offers opportunities to save, especially with favorable returns on savings. 2. Only 22% of Americans nearing retirement say they have enough money to retire. For many workers, the biggest worry isn't how they'll spend their golden years, but whether they can afford to retire at all. Retirement, once a given, is now as uncertain as buying a home or starting a family. According to a recent Bankrate survey, nearly one-third of U.S. adults working full-time, part-time, or temporarily unemployed believe they need over $1 million to retire comfortably. Yet 45% doubt they'll ever save that much. Over half of the workforce, 56%, must catch up on retirement savings. But despite the daunting statistics, it's crucial to remember that saving anything is better than nothing. This sentiment has mostly stayed the same over the past year. In 2022, 55% felt behind, including 35% who felt significantly behind. Those numbers are almost identical today, with 37% feeling significantly behind. Only 16% of workers feel ahead of their retirement savings, with just 6% feeling significantly ahead. Another 21% believe they're on the right track. A quarter of workers have yet to contribute to their retirement in the past year. In 2023, 22% admitted to not making any retirement contributions. However, 25% said they are saving more than before, 36% contributed the same, and 17% contributed less. Generational differences are also stark. Gen Zers, ages 43 to 58, are the most worried, with 69% behind on savings. Baby boomers, millennials, and Gen Z also express concern. 3. The average American household has $132,500 in debt. Even as household net worth rises, reaching $6.2 trillion by the end of 2023, so does debt. Personal debt in the U.S. has hit a staggering $17.5 trillion. Each American adult owes $6,795, with 77% of households shouldering some debt. Most debts come with agreed payment terms, which include specific payments at set intervals, usually with interest. Common types of debt in America include credit card debt, student loans, auto loans, home equity lines of credit, and mortgages. While all age groups use debt products, the level of debt varies across ages. A staggering 8 out of 10 American adults have at least one credit card, and nearly half, 48%, carry a balance at some point each year, meaning they don't pay their credit card balance down to zero each month. This results in over 100 million people having credit card debt, with an average debt of $6,569 per person. The total credit card debt in the U.S. has reached $1.13 trillion. The average annual credit card percentage rate is 22.63%. If you calculate that interest on the $1.13 trillion owed, credit card companies stand to make around $256 billion in interest. For many, housing is the biggest monthly expense. Americans with mortgages pay a median monthly payment of $1,672. Mortgage debt accounts for 70% of all American debt, totaling $12.25 trillion. There are over 84 million outstanding mortgages in the U.S., with the average mortgage balance at $145,800.
Number 4.
44 million Americans have student loans. When choosing a college, students often consider the cost and how they'll manage to pay for their education. Federal student loans can bridge the gap for those unable to afford rising tuition fees, but they also lead to significant debt. Whether owing $5,000 or $200,000, over 43 million Americans carry student loan debt. But why? Well, college costs have surged over the past 30 years. Tuition at public four-year colleges has jumped from $4,160 to $10,740, while private nonprofit institutions have seen costs rise from $19,360 to $38,070, adjusted for inflation. As education becomes more expensive, the reliance on student loans and financial aid grows. Today, over half of all students graduate with debt. Young adults bear the brunt of this financial burden. Those aged 25 to 34 owe around $500 billion in federal student loans, typically between $10,000 and $40,000 each. However, student debt isn't just a young person's issue. Individuals aged 35 to 49 owe over $620 billion, with many in this group owing more than $100,000. Even retirees aren't exempt. 2.4 million borrowers aged 62 and older owe $98 billion. The COVID-19 pandemic has dramatically impacted student loan payments. Since March 2020, federal student loan payments have been paused, but this pause has yet to see any end as of June 2024. Before the pandemic, only 2.7 million borrowers had their federal loans in forbearance, but by 2021, that number soared to 24 million. Unlike federal loans, private student loans didn't receive widespread forbearance options.
Number 5.
You're less likely to budget if you earn less than $75,000 annually. Many people dream of earning enough money to live comfortably without financial stress, but what does that number look like? According to a survey by SunTrust Bank, 1 in 3 people earning more than $75,000 still live paycheck to paycheck, at least some of the time. Even among those making $100,000, 1 in 4 feel the same way. While these incomes are well above the poverty line, many of the 500 people surveyed blame their struggle to save on frequent nights out and entertainment expenses. However, location, family size, and healthcare needs can make even $75,000 insufficient to cover all expenses, let alone save for college, retirement, or emergencies. Elise Gould, a senior economist at the Economic Policy Institute, explains that middle-class families are expected to save for a rainy day or job loss. However, a $75,000 might be pretty close, depending on where you live. For instance, in New York City, a family of 4 needs $94,700. These figures don't even account for savings. In other parts of the country, families can get by on less. For example, a family of 4 needs about $64,000 in St. Louis. However, several factors can cause financial strain even at this income level. For instance, healthcare costs are rising, especially for those with employer-sponsored plans. The average cost of such plans for a family reached $24,000 in 2022, with employees paying $6,570 of that amount. Premiums and deductibles have significantly increased over the past 5 years. Number 6. 10 million American households don't have a bank account. It's surprising, but about 4.5% of U.S. households don't have a checking or savings account. During the pandemic, this rate declined as many people opened accounts to receive government stimulus funds. However, significant disparities still exist between those with bank accounts and those without. Historical access to bank accounts has varied based on income, education, and race, and this pattern continues today. Households without a bank account often turn to expensive alternative financial services like check cashing and payday loans, which can further strain their finances. But why might someone not have a bank account? Well, There are several reasons. Many cite not having enough money, high or unpredictable fees, and distrust of banks. Other reasons include privacy concerns, not qualifying for an account, banks not offering the needed services, and the inconvenience of bank hours and locations. The federal government has been working to help more people access basic bank services. They've rolled out initiatives such as toolkits, checklists, and public awareness campaigns to educate consumers about financial products and the process of opening an account. Programs like the Federal Deposit Insurance Corporation's MoneySmart aim to boost financial literacy, helping people understand the benefits of having a bank account and how to choose one that suits their needs.
Number 7.
2 out of 5 Americans have committed financial infidelity. Talking about money can be incredibly tough, regardless of where you're from or what you earn. It's often seen as more uncomfortable than discussing the most sensitive topics. Money touches our pride, ego, and sometimes our shame. Perhaps because of this, some people resort to hiding their financial transactions from their partners, a practice known as financial infidelity. Hiding money matters from a partner can strain relationships already under pressure, sometimes leading to their breakdown. Understanding why someone might need to conceal their spending, especially when it becomes unsustainable, can be complicated. So what drives overspending, let alone hiding it? The truth is, social media could play a role, with many feeling pressure to maintain appearances beyond their means. A recent study found that 28% of young adults admit to posting Instagram photos that portray a wealthier lifestyle than they lead. This pressure to keep up appearances can lead to financial strain or even bankruptcy, driven by the desire to maintain a certain image.
Number 8.
Spending beyond your means. A significant majority of Americans, about 61%, are living paycheck to paycheck, a trend affecting both low-wage and high-income households alike. According to recent research by Lending Club, those with lower incomes, earning less than $50,000 annually, are particularly vulnerable, with nearly 8 in 10 able to cover future expenses only once their next paycheck arrives. Surprisingly, even among higher-income Americans earning over $100,000 annually, 4 in 10 are in a similar predicament. This financial situation is considered risky because it reflects a lack of savings to handle emergencies, leaving households unable to meet upcoming financial obligations until their next payday. The percentage of Americans living paycheck to paycheck has risen by 2 percentage points over the past year, particularly due to inflationary pressures. However, recent data suggests a slight easing from peak levels in mid-2022. Non-essential spending, such as on travel, dining out, and streaming services, also plays a role in straining financial stability. For some paycheck-to-paycheck consumers, about 21% attribute their financial challenges to such discretionary spending, with 10% identifying it as their primary reason for living paycheck to paycheck. However, it's important to note that most paycheck-to-paycheck consumers are not indulging in unnecessary expenditures. Their incomes are predominantly allocated to essential expenses, quickly absorbing their earnings. For instance, median rent for a one-bedroom apartment is approximately $1,510 monthly, while monthly food costs average around $690. Additionally, essentials like transportation and healthcare further strain budgets, with typical monthly expenditures totaling about $3,550 for middle-income earners before taxes. As the cost of living continues to rise, managing cash flow and adjusting spending habits remain critical for households striving to build savings and achieve financial stability. Now you know all the statistics. So, are you prepared for unexpected financial challenges in today's economy?
Comment down below.
In the meantime, make sure to leave a like, subscribe, and turn on the notification bell for more amazing videos.